I'm Greg Hunter. Happy New Year. Welcome to USAWatchdog.com, the first guest for the brand new year. I'm thinking, what's going on right now? The oil prices is crashing. They're tied to derivatives. There's this big dollar carry trade. I think Zero Hedge was just talking about a $9 trillion US dollar oil carry trade last week. Who knows all about derivatives and was trading derivatives in the 1980s as a broker for a big bank? That'd be Rob Kirby of Kirby Analytics. Rob Kirby, thank you for joining us today on USAWatchdog.com to inform us about what's going on in the oil market. The oil market, people pull up to the pump and they're just loving it, Rob. And they're thinking that this is happy days are here again, but it's not so happy, is it?
Well, Happy New Year, Greg. And with regards to the oil market, I look at what I see transpiring in front of me in the crude oil market as yet another engineered piece of financial engineering or trickery on the part of the financial elites. The action that we've seen in the crude oil market, to me, mirrors the same sort of action that we've seen in the bond market and the zero interest rate policy, all engineered. The crash of the Russian ruble, the demonization of Russia, all engineered. The suppression of precious metals prices in what are supposed to be free markets, all engineered. And this collapse in oil prices is yet another engineered event with a much bigger goal, in the offing. And I think we're going to, in the fullness of time, we will see it all unfold. That what this breakdown in the crude oil price is going to spawn is going to be another financial crisis. It will be tied to the junk debt that has been issued to finance the shale oil plays in North America, and the extent of the issuance of junk bonds to finance these shale oil plays is reported to be in the area of $500 billion worth of junk debt that's held largely on the books of large financial institutions in the Western world. And when these bonds start to fail, jeopardizing the future of these financial institutions, I do believe that will be the signal for the Fed to come riding to the rescue with QE4. And I think that QE4 is very likely going to be accompanied by bail-ins, because we all know that in the Western world, all Western world countries have adopted bail-in legislation in their most recent budgets. And I think what we're doing is we're engineering, the financial elites are engineering the excuse for their next round of money printing, and this time it'll likely be accompanied by bail-ins, where they start literally confiscating money out of people's savings accounts and from their pension accounts. That's what I think is in the very near future coming toward us, Greg. It's like a train coming through a tunnel. We see the light, we think it's sunshine, it's really a train.
Well, that's pretty ominous, opening round here. What about the people who say, the economy is slowing down? Some people are saying, the 10-year Treasury is going to be, below 2% and stay there for a long time because the economy is so weak, and that, the demand for oil is way down, although Saudi Arabia keeps, pumping out oil in the face of falling demand. Is that part of the engineering? Is that what there is some of this, the bad economy and the demand going down, and then they're just pushing that over the cliff?
Well, I mean, when you speak about the economy slowing down, and when you speak about there being no growth in the economy, that's in direct contradiction to whoever it is who produces the latest GDP, where they revised third quarter GDP in the United States from up 3.5% to up 5%. I mean, you see, Greg, official data is inconsistent with what you can empirically observe going on in the economy. The economy isn't doing well, but in addition to the economy not doing well, the U.S. government, for all intent and purposes, is insolvent. And why bonds would be rallying against the backdrop of an issuer who's insolvent is beyond anybody's fundamental understanding. But fundamentals don't count anymore in what we see in our markets. I'm gonna harken back to words that were uttered by GATA Secretary and Treasurer Chris Powell in 2008, when he stated at a GATA conference in suburban Washington, D.C., he said, "We don't have markets anymore. We just have interventions." And this is so true, Greg, because as I spoke of earlier, with the engineered results we're seeing in the commodities complex, in the currency complex, especially with metals, zero interest rates, and with crude oil and the energy, anything that's strategic, it's all engineered. And we know this to be fact because none other than former Fed Governor Kevin Warsh, just after he stepped down as a serving member on the Fed Open Market Committee, he stated that he wrote a treatise that was published in the mainstream about financial repression and how it was incumbent upon the Fed to act in markets to change or make different prices and strategic things that aren't in line with official elitist policy. I mean, this is the hallmark. This is the hallmark, Greg, not of capitalism, which many pundits in the markets claim that capitalism is failing. This engineering, this financial engineering is all symptomatic, and it's all a hallmark of communism or central planning. And we know because of the failure of the Soviet Union, the former Soviet Union, central planning has a track record of failing. Capitalist policies where things are allowed to fail and market forces are allowed to exert themselves in a free form, markets can clear and they're viable. But what we're experiencing today, Greg, is so far away from free market or capitalism, and resembles so much of central planning failed policies, and that's what we're experiencing. And sorry, you go ahead.
No, go ahead.
Well, I just wanted to get into the notion. I'm trying to get at the cause of what's ailing us, and what's ailing us is the central planning that I speak of. This is the root cause. But you see, pundits and the mainstream press seem to be preoccupied with the symptoms, and the symptoms are zero interest rate policy. The symptoms are a Russian ruble that's been crushed in an engineered way. The symptoms are a crude oil price that's been hammered down and cut in half in as little as 2 or 3 months. The symptoms are bond prices up through the roof and interest rates at zero. And this is all from issuance of entities that are, by most standards, these are insolvent issuers. And you see, so those are all symptoms. But the real cause is that we've been taken over by this central planning edict. And it's the same thing. We can talk, Greg, as I said to you off air just before we started. We can talk about runny noses, and we can talk about the way you get rid of a runny nose is with a decongestant or an antihistamine, and we can talk about having a cough and you take a cough drop, and we can talk about having a fever and you can take an aspirin. So we can talk about all the symptoms, or we can say you have the flu. And what do you do holistically to treat the flu? Well, we can also talk about holistically what do we do to rid ourselves of this menace and this disease called central planning, which really beckons bigger questions about what's occurred in our society and how we've gotten here and what do we do to remedy that. So
let's go back to the oil play, because that's going to be the next. You're saying that is the next, engineered event. Is that correct? That the crashing of the oil prices, the destroying of this leverage, the implosion of the shale industry, the implosion of Russia. You're saying that they're going to do that. They're doing that so they can bring on another round of QE. Explain that. Go into detail on that.
Yeah. Well,
how are we going to buy that?
Let's really look at the whole notion of QE and its causes and its roots. The world has become very global, and globalists are controlling the world, and these globalists control the financial apparatus, and they also control the fiat money mechanism, which is centered on the U.S. dollar. But when you're looking at the extension of the U.S. dollar or the maintenance of the U.S. dollar as the world's reserve currency, I don't believe anymore you can look at, for instance, the Fed's balance sheet in isolation. You need to look at the Fed, the Bank of Japan, and the ECB, in conjunction with one another, because the life cycle of fiat money, when fiat money inflects in its life cycle, the amount of fiat money in the system has to grow vertically. And since 2008, which I would argue was when we inflected, and the supply of money in the system has grown vertically, there has perpetually been at least one of those three major entities that I just spoke of, Bank of Japan, ECB, or the Fed, printing money. So one or the other has been printing continuously since 2008, and the things that they've put in place with these currency swap facilities between the major nations basically means that the Fed can raise a flag and say, oh, we're not printing for the next 6 or 8 months. We've stopped our QE. But really all they've done is they've passed the baton to the Bank of Japan, who are printing like hounds. They're printing fiendishly. And you see, all they've done is they picked up where the Fed left off. And it sounds like at some point there might be a little baton pass or a little bit of additional stimulus, money printing coming from the ECB. And sure then God made little green apples, Greg. We're going to see in the very near future a made in America financial crisis regarding this shale oil junk debt. And they're going to use that as the excuse for yet more money printing from the Fed, and or in conjunction with bail-ins, where they're going to start harvesting the wealth of individuals and their pensions. But I mean, this is the path we're on, and this is the path we're going to continue on until the whole bloody mess collapses. But this is where we're headed.
Do you think that 2015 is the inflection year? I mean, how many more of these big blow-ups can they, have a big financial calamity, which would be bigger than the last one? Everybody has told me the banks are big. I mean, Jim Rickards, for example, he says, well, it's going to be bigger because the banks are bigger. There's more leverage, so this will be bigger than the last one. It has to be. And how many times can this get bigger than the last one before it collapses and we have a new system? My question.
Well, the answer to that is how big can a balloon get before it bursts? And, the question is, balloons can get maybe bigger than you think they can get, as long as people keep believing in the purchasing power of the currency of the realm. And, so that can go on. It's the question you're asking, Greg, is once something's ridiculous, how ridiculous can it get? Well, by the very notion of it being ridiculous to begin with, things can get a lot more ridiculous than a lot of sane people would imagine, because you're already in the theater of the absurd. So it's how grand can the theater of the absurd really be? And that's the question you're asking, and that's a really tricky question to answer.
How far do they have to push oil prices down? I mean, if you'd have told anybody 6 months ago, wow, oil's going to get cut in half. It's going to go from, in the hundreds and the high 90s and the low hundreds to the 50s. you'd have been laughed out of the room. People would have said you're crazy. There's no way that's going to happen. Well, it's in the 50s. Can it go lower? Will it go lower? Do they have to push oil prices lower to get an inflection point, an explosion in that debt and that form of debt, which could bleed into all the other debt that the banks have and the trust of the collateral? Could that? How far did that push down oil prices? And could that not just be the bonds in shale, but could it jeopardize other forms of bonds, quote, collateral that that bankers don't trust?
Well, I'm going to answer that question it might be a little bit convoluted, but I want to answer it in this way. First of all, the mainstream punditry would have it that the collapse in price of crude oil was brought on by a glut of supply, which came from the shale oil plays. And, the best way to resolve a glut in supply of crude oil coming from high-priced oil, which shale plays are lower prices, because a lot of that excess capacity or current excess capacity is going to come offline, or it's going to be shuttered with lower prices because it's not economic to produce it. Because shale oil, by most recognized standards, I think they need a crude oil price of $70 at least to justify production. And with prices in the low 50s currently, I would say that crude oil prices have been driven low enough now to spawn a crisis. And and the only variable, or the only thing that we have to wait for, is some time to pass when these bonds that have been written start to not perform. So I think from that standpoint, crude oil prices are low enough now to cause problems. But for effect, might they drive them lower? Sure, they could drive them lower, because understand that it's back to discussing this absurd theory again, because the prices are engineered and are arbitrarily set where they are today. It's not fundamentals that have put the crude oil price where it is. They've been engineered to come here. And it's sort of like asking, Greg, so how low can the 10-year bond go? Well, the 10-year bond shouldn't be where it is right now. If we listen to John Williams and his shadow stats information about what real inflation rates are in the United States, I think he currently has them at around 6 or 7% a year. And this I think is with a diminished oil price, but because food prices are up across the board. Services, I don't think anybody's college tuition's gone down lately. I don't think anyone's insurance rates have gone down lately. I don't think anyone's health care costs have gone down lately. Most of the people that I talk to in the United States of America have told me that their insurance rates have doubled or tripled. So, these are offsets to getting a few bennies with cheaper oil. But we have inflation. Inflation is higher than it's being reported. And, Economics 101 tells us that the 10-year bond rate or free risk, zero risk rate should be the real rate of inflation plus about 250 basis points. Well, if real inflation is 6%, and if 10 years should be 250 points over that would be 8.5% 10-year. But the reality is they've got the 10-year trading at 220 or 217. And, can they make it go lower? They can make it go lower. They can make it go lower because they have the ability to make the banks captive buyers of any amount of debt they choose to issue. And, will they employ that to drive rates lower? I suspect in the future they will. And this will be so they can rub people's noses in it, saying that for all you people saying that we've issued too much debt, and it's a bubble and it should be sold. Well, we're going to show you that it's really a great buy, because we can make the yield go from 217 maybe down to 185 like it was 3 months ago on a short-term spike down. So all I'm saying is they have the tools and the ability to do this, and they've shown us in the past that they have no hesitation to use them.
With oil prices where they are now, you're saying that, let me get this right, that this is not going to go on to 2016 or 17 or where. 2015, this particular engineered crisis is going to blow this year. The low oil prices, the bonds surrounding him, the collateral surrounding him, you say that's going to blow this year.
Oh, yes. Yes, without a doubt it will. It must. It must. Because, you see, the income that the crude oil sales generate are used to pay the interest on the debt. And I mean, and if you have to make payments, if you have to make coupon payments on that debt of X, but your revenue is only X divided by 2, you're in a default situation. You see, Greg, if you have a mortgage payment of $5,000 at the end of the month, and you only have $2,500, you defaulted. And so that's what's going to happen here. That's the position they're in. That's the position they are in right now. So we just need to wait. We just need to wait for some coupon payment dates to come and go, and because these guys won't have the money,
and you
because
say
they don't have the income.
This is going to be weeks away, months, not year, not next year. Weeks or months?
I don't know if you've ever heard in a comedy sketch, and I don't even know who to attribute it to, but there's a famous comedy sketch I know where the comedian speaks of, we're producing. I'm gonna use the example of oil. Well, we're producing barrels of oil that cost us $70 a barrel, and we're getting $50 a barrel for them. And the guy goes, well, that doesn't sound like a good, or the foil says, well, that doesn't sound like a good business proposition there. And he says, yeah, but we're going to make it up on volume. Go figure. But, this, believe it or not, you laugh, I call it gallows humor. This is the kind of thinking that predominates our financial edifice today. This is the kind of hubris that our financial elites. This is the way they're acting. They're beating their chests that they can do this and get away with it. And you know what? And so far they have got away with it. But you know what? There's a saying: not nice to fool Mother Nature, not nice to fool the laws of economics either. Greg, catches up to you in a hurry.
One of the things you also do is you acquire and find and locate and facilitate tonnage of precious metals, i.e. gold. And where you started quite a little controversy. A lot of people were naysayers saying that you're at least 50% for tonnage. That people in Asia or in the Middle East, I suspect that's where they are paying at least 50% over the stated spot price, at least 50% over the stated spot price. Some people would say, well, listen, I looked online and I couldn't find anything online. I told them you can't find everything online. Would you like to double down on that, what people are paying? And you're actually seeing this. You're actually doing deals where they are paying more than 50% over spot. Is that correct?
You know what, Greg? I'm gonna say it this way. I'm not, and to be honest, I never did say that every trade that happens at 50% or more over spot. But what I'm saying is there certainly are transactions that are occurring, and substantial transactions that are occurring at these elevated levels. And I think you and I both know that there's been some pretty good confirmation that this is indeed occurring. I know it's occurring personally.
Actually, GATA told me they independently beyond your source.
And you see, I don't really want to dwell on that because I don't want to put the thought in the market that every trade that gets done at these elevated prices. But all I can tell you is certain transactions are being done at these levels, and it depends on who you know and what circles you travel in as to whether you get those kind of deals.
And I mean, is there still a rush for this? One of the big things about the mortgage crisis was nobody trusted the collateral, nobody trusted the bonds. And here we have another situation where we have these shale bonds, and we have, the bonds again, at least some of the bonds. Nobody will trust the collateral. Nobody will trust the bonds. And what do they run to? They run to gold. Is that going to be a continuing a theme until we have, your supernova event for the U.S. dollar, which has been climbing, incidentally. It's up in the, 90s on the USDX. I think it's 90, around 90. Is that going to continue? Is the dollar going to continue to go up in price? Is gold going to be continued to be accumulated by big sovereign wealth funds and nations?
There will be a continued and an accelerated run towards physical precious metal, and we're seeing evidence of that because there are shortages of a lot of selected different products in the physical bullion realm today, whether it's coins from the mints of the United States or from the mints of Canada, or whether it's in tonnage of investment-grade bullion around the world, whether it's gold or silver. And I expect this to increase and intensify over the coming months. And I do think that at some point in the very near future, I do believe the dollar will crest. And I think that the prospects of the dollar going down hard over the next year are very, very, very I think it's sage to say that this is likely outcome for the dollar.
They want it to go down, though. They'll want it to go down at some point, won't they?
Well, at some point they're going to lose control because frankly, I think what is likely going to happen. The United States has dollarized so many countries around the world. And these are countries, whether it's in Latin America or different countries in Africa, who have given up on their own currencies and they've adopted the U.S. dollar as their currency de jure. And this has allowed the United States to grow their money supply, increase the amount of dollars in circulation around the world. But at some point, I do believe foreigners will lose faith in the U.S. dollar. And when that occurs, the dollars will come home. And I'm sure the Fed probably has some sneaky ideas up their sleeve to try and prevent this backwash of dollars returning home. Because when these dollars try to return home, it's going to create severe inflationary pressure in the United States.
Is this why big countries are going to gold? They're just going for the
Absolutely,
premier,
it is.
They're going for the premier collateral.
Absolutely they are. And then God help us all, Greg, the day that countries, Western countries, if they ever throw in the towel and they try to get some diversification in their official reserves. If you look at the Tick report that's published by the U.S. Treasury, and you look at the holdings in dollars in the reserve accounts of countries around the world, and if the countries listed in the Tick report were to just try and convert 1 or 2% of their holdings of dollars into something physical in the precious metals realm, the pressure that would be put on the metals would be absolutely unbelievable. And, could that happen? And is that likely to happen at some point in time? I believe so. Because to me, the answer to that question is, will people run from a burning building at some point in time? The smart ones will. And there may be some with a death wish who decide to get consumed in the building. But I do believe once a building's under fire, people will try and bolt for the door.
Last thing, I don't really talk to you about war, but I'm going to because it's part of the investment thesis. I mean, war, gold, oil, that's all part of the same world stage. We're building up a bunch of vehicles. I think we have 3,000 vehicles in Kuwait. And I'm wondering if this is just for ISIS or that western Iraq and eastern Syria, or I wonder if this is just for ISIS, supposedly, or that they're worried about a wider war breaking out, and boy, we might have to go in and defend Saudi Arabia, or we might have to repel the Iranians. They're in Kuwait. So, what do you think about the war card in the Middle East? I think the next war is going to come from the Middle East.
I think the prospects of the next war. I think there's still an Iran card on the table in my view, but probably bigger than that. I think it's Russia.
What's the Iran card? The Iran card is what?
It's been an ongoing drumbeat against the Iranian regime, dating back to the hostage taking and the fall of the Shah back in 79, 80. Iran has been persona non grata to the American ruling cable, and this has been an ongoing issue which has been inflamed to the point of seemingly inevitable armed retaliation or interventions at different times, and then at other times it seems to back off. And right now, if anything, it maybe seems like it's in a bit of a lull, and there could be a bit of a fig leaf. But probably more so than Iran right now, I think Russia, because the amount of demonization and the amount of finger pointing that the West has been doing with Russia in recent months is, in my view anyway, it's unwarranted. It's provocative, and best we watch how hard we push on that string, because in my view anyway, is the possibility of armed conflict, direct armed conflict between Western forces and Russian forces likely. I think it could even be inevitable. So that's a very dangerous situation in my view.
Rob Kirby, Kirby Analytics, thank you so much for coming to us from Canada. Rob Kirby, thanks for kicking off 2015 with your analysis and taking the time to talk to us. Thank you very much, sir.
All the best in 2015 to you, Greg.